Welcome, curious learners, to the Deep Dive. We're here to unpack complex information, find those surprising facts, and give you some clear insights. Today, we're diving deep into some serious turmoil surrounding a really historic British retailer, WH Smith PLC. You've probably seen them everywhere, right? Especially in airports. Now imagine this. The company carefully reinvents itself, it's all set for this new era of growth, and then bam, nearly half its value gone. In just one day, we're talking over 580 million wiped out. That's exactly what happened to WH Smith on August 21st, 2025. So the big question is, does this huge market reaction signal something fundamentally broken? Or is it maybe an overreaction to a problem that, well, maybe they can fix?
Exactly. And that's what we're going to explore. We'll look at this whole moment through a value investing lens, digging into the details. Not just what happened, but why it hit so hard. And crucially, what does it mean for the company's future? Is this just, a temporary storm before they get back on track? Or is it a sign of deeper issues? We'll lay out the bull case, the argument for buying, and the bear case, the reasons to be cautious. Help you decide if this is a real opportunity or maybe a classic value trap.
Okay, sounds good. We've got a lot to cover, from their basic business model, internal controls, financials, even how the market's feeling about them. Let's dive in. All right, let's kick things off by really understanding the company itself. We'll start with Chapter 1, Business Analysis. A tale of two journeys. So WH Smith PLC, the ticker is LON.SMWH, and the key date is August 21st, 2025. That day, the shares closed way down at 642.50 pence. A brutal session, erased almost half its value. But what was the picture before this crash?
Well, what's so interesting, or maybe ironic, is that this crisis hit just as they completed this massive strategic shift. On June 30th, 2025, they'd actually finished selling off their entire UK high street business. The idea was to become a pure-play global travel retailer.
Pure-play global travel retailer.
Okay. Yeah, the whole focus was meant to be on news, books, and convenience items specifically for travelers around the world, aiming for higher growth, better margins.
So when we say pure-play travel retailer now, what does that actually look like? Where are they operating?
Their whole model now is about getting prime retail spots in places with tons of foot traffic, specifically transit hubs. So think airports, train stations, hospitals, even motorway service areas. Anywhere there's a captive audience of travelers.
The captive audience needing something right then and there.
Exactly. That's the core idea.
And is this mainly a UK thing, or are they bigger than that?
Oh, it's definitely global. They operate across three main segments. Travel UK is the biggest, most established part. Then there's North America. That's the second largest profit contributor. And critically, it was supposed to be the main engine for future growth. They operate under the WH Smith name there, but also the InMotion brand they acquired, which focuses on tech products, headphones, chargers.
Ah, right. InMotion, I've seen those.
And the third segment is Rest of the World, or RW. That's a growing portfolio. They're in over 29 countries now, and that's seen as key for long-term international expansion.
Okay, so the strategy is about getting more money out of each passenger.
Right.
Increasing what they call spend per passenger.
That's it. Increasing average transaction value, ATV, and conversion rates, getting people in the door and getting them to buy more.
And how have the products changed to make that happen? It's not just newspapers and magazines anymore, is it?
No, definitely not. They've expanded quite a bit. Key growth areas are things like health and beauty curated travel-sized items. Tech accessories are huge, high margin, mainly through those InMotion stores. And food to go has become much bigger. They even have their own brand, Smith's Family Kitchen. Plus, they use partnerships strategically, like with Marks & Spencer or Costa Coffee, to widen the appeal.
That sounds pretty comprehensive. So where does this leave them in the market? How strong is their position?
They're a major player. Over 1,700 stores globally, 30-plus countries, and over 1,200 of those are travel outlets. North America is really the focus for growth. They've got about 14% of that market, which is quite fragmented, and the goal was ambitious, reach 20% by 2028.
Which makes this operational failure we're discussing.
Exactly. It hits right where their growth story was supposed to be happening. Very concerning.
And for us, the travelers, what's the appeal? Why do we stop there?
It's just sheer convenience, isn't it? Especially when you're kind of stuck in an airport or station. They solve those immediate needs, the forgotten charger, a snack, a book for the journey. And because you're a captive audience, maybe you're less sensitive about the price.
Helps their margins.
Absolutely. And don't underestimate the brand. WH Smith has been around 233 years. That familiarity builds trust, which is really valuable when you're somewhere unfamiliar.
Makes sense. What about the industry itself? Travel retail, is it growing?
Oh yeah, it's a large market, very dynamic, and it's structurally growing. Some estimates project it could double between 2025 and 2032. We're talking maybe $72.5 billion growing to over $145 billion.
Hmm.
That implies a compound annual growth rate, a CAGR of somewhere between 8.5% and 10.5%.
Wow, that's strong growth. What's driving it?
Well, continued recovery in travel post-pandemic, rising incomes globally, favorable regulations in some areas, and just huge investment in airports and transport infrastructure. Plus, you see consumers shifting a bit towards more premium products, more experiential shopping, even in transit. WH Smith is trying to tap into that.
Who are they up against? Who are the main competitors?
It's fragmented, like I said. Globally, you've got giants like Avolta, Lagardère, but in their specific niche news, books, convenience, it's often more local or regional players. Their sort of one-stop shop approach does give them an edge, though.
Okay. It sounds like it's tough for newcomers to break in. What are the main barriers to entry?
Absolutely. The biggest one is just getting access to that prime real estate inside airports or stations. It's highly competitive, often long-term contracts are involved. Then you've got the high upfront cost of fitting out the stores, the complex logistics of operating in secure zones, and of course, established players like WH Smith just have economies of scale that are hard for a new entrant to match.
So boiling it down, what are their core competitive advantages? What really protects them?
I'd say, first, the brand strength and recognition. 2 centuries of history counts for something. Builds instant trust. Second, their huge global footprint gives them those economies of scale we mentioned, helps with efficiency. And third, they have this really disciplined focus on cost control, kind of a legacy from their high street days, which is vital in retail. But really, the most critical, hardest thing to copy is that portfolio of long-term leases in the best travel locations. That's what gives them the captive audience.
The leases rate.
Yeah. And they also talk about this unique forensic approach to retailing. Basically, using data for everything, store layout, product mix, to squeeze out maximum sales per square foot.
Okay, here's the kicker, isn't it? They sell the high street business. They're ready for the market to see them as this pure travel growth story.
And then this happens, August 21st, an accounting error. And not just anywhere, but specifically in the North American division, the designated growth engine.
Couldn't be worse timing.
Absolutely dreadful timing. It throws everything into question. The quality of their earnings, management's grip on the business, the reliability of their financial controls. Suddenly, that 20% market share target for North America by 2028 looks, well, a lot harder to believe.
Yeah, that really sets the stage. Which brings us perfectly to our next section, Chapter 2, Management Evaluation, a crisis of credibility.
Right. So the current leadership, that's Group Chief Executive Carl Cowling, he came in November 2019. He did steer them through COVID reasonably well, but this $30 million overstatement of profit in North America, it's a massive blow to market confidence.
A $30 million overstatement. Can you unpack that a bit? What exactly went wrong there?
The company attributed it to the accelerated recognition of supplier income. Now, that's jargon, but what it essentially means is they were booking income or discounts from their suppliers before they should have under accounting rules.
Making profits look better than they actually were.
Precisely. Artificially inflating profits. And that phrase, accelerated recognition, immediately sets off alarm bells for analysts. It sounds very similar to what happened in the big Tesco accounting scandal a few years back.
Not a good comparison to draw. How did management handle the announcement?
Well, they followed the standard crisis playbook, a quick announcement to the market. They quantified the hit at $30 million, and they brought in Deloitte for an independent review. But the market's reaction, that 42% share price drop, tells you everything you need to know about the loss of trust. It wasn't enough.
And the timing with the CFO change. That complicates things too.
Hugely. The long-serving CFO, Robert Moorhead, is retiring. His replacement, Max Izzard, coming over from Burberry, is due to start on September 1st, 2024. So this crisis explodes literally days before the new finance chief walks in the door. It creates a leadership vacuum at a critical time and makes the turnaround job much, much harder. Execution risk goes way up.
What about their reputation? They talk about an open and honest culture. They had a top ESG rating. How does this fit?
It doesn't fit at all, does it?
Sure.
WH Smith does emphasize that culture and holds a top-tier AAA ESG rating from MSCI. This accounting failure completely contradicts those stated values. It puts their ESG credentials at serious risk. You could see ESG-focused funds deciding to sell their shares because of this.
And did the CEO step up immediately?
Well, there wasn't a particularly visible, direct leadership voice from the CEO right in the immediate aftermath, which probably didn't help calm nerves either.
Okay, let's shift to how they've been using the company's money. Capital allocation, what's the strategy been?
The strategy itself has been very clear. Get out of the high street, double down on travel retail. So they sold the UK high street business for up to 40 million rounds, sold funkypigeon.com for 26 million, and plowed resources into the core travel segment.
And within travel, where did the investment go?
Focused on four main things: growing store space, increasing that average transaction value, ATV, developing new product categories, and just constantly managing costs and cash. Pretty standard retail priorities, really.
And returning cash to shareholders, dividends, buybacks.
Yeah, they have a progressive dividend policy. They brought the dividend back in FY 2022 after pausing during COVID. The last interim one was 11.3 pence per share. They also started a 50 million share buyback program back in September 2024. By April 2025, they'd bought back about 27 million worth of shares.
Okay, but wait. If they were buying back shares based on profits that were overstated.
Exactly. That's the really problematic part. The buyback was happening based on financial projections that we now know included these inflated profits. So management was buying back shares, often above 1,000 pence, using inaccurate information. That's just inefficient capital deployment. It effectively destroyed shareholder value compared to if they'd held onto the cash or waited.
Ouch. So what does this do to that key metric, return on invested capital, ROIC?
It's bad news for ROIC. Like you said, it measures how well they turn investments into profit. Before this, their reported ROIC was about 9.26%. Their estimated cost of capital, their WACC, was around 8.83%. So a very thin margin, just barely creating value. Now, with this 30 million profit hit, their ROIC will almost certainly fall below their WACC. Which means going forward, there's a real risk that every pound they invest to grow could actually be destroying shareholder value. That's a serious red flag for investors.
Okay, that's a sobering thought. Let's dig deeper into the actual financials then. Chapter 3, Financial Analysis, Reevaluating the Numbers.
Right. So after the crash, the total market value of the market capitalization dropped to around 797 million. That's, as you said, over 580 million lost in one day. Huge hit.
How had revenue been looking over the last 5 years? Obviously, the pandemic must have skewed things.
Absolutely. If you look at the 5-year trend, you clearly see the pandemic dip in 2020, 2021, but then a strong recovery. Revenue jumped 58% in 2022, another 28% in 2023. It moderated a bit in fiscal 24, but still a healthy 7% growth. The trajectory was positive.
Well, what about profit margins? Revenue is one thing, profit is another.
Good point. Gross margin, that's revenue minus the direct cost of goods, has actually been pretty strong and improving, around 63.8% for the last 12 months, TTM. But operating margin was lower, about 11% TTM. And net profit margin was incredibly thin, just 0.36%. Very little cushion. And the company's revised guidance for fiscal 2025 now points to a profit before tax margin of about 5.5%. That's a big drop from the 8.7% they achieved in fiscal 24. Margins are getting squeezed.
But one bright spot was always their cash generation, right? Free cash flow.
Yes, that is a key strength. It went negative during the worst of the pandemic, but since then, free cash flow has been consistently positive and growing. It hit £53 million in FY 2024. That ability to generate cash is going to be absolutely crucial for them navigating this period. It gives them some breathing room.
How consistent were earnings historically before this issue?
Before the pandemic, say 2015 to 2019, they had pretty steady earnings per share, EPS growth, reliable. Then, obviously, the pandemic hit, losses in 2020, 2021, followed by that strong recovery from 2022 to 2024. But now, these accounting irregularities just cast doubt on the quality and reliability of that recovery. It breaks that long track record.
You mentioned leverage earlier. How much debt are they actually carrying?
Yeah, the debt-to-equity ratio is high, somewhere between 2.88 and 3.16 times. That means their debt is roughly 3 times the value of their shareholders' equity. That level of leverage is a significant risk. It magnifies losses, makes them vulnerable if profits fall further or interest rates rise. There's very little room for error now.
What about their ability to pay immediate bills? Liquidity.
Their current ratio, which compares short-term assets to short-term liabilities, is around 0.74. Anything below 1.0 means you have more immediate debts than readily available assets. While that's not uncommon for some retailers who turn over inventory quickly, given this crisis, it does highlight a potentially precarious short-term financial position.
And the dividend. You mentioned it came back. Is it safe now?
Well, they did reinstate it and were growing it, but the payout ratio based on recent earnings was actually unsustainably high, over 600%. It looked better covered by free cash flow, though. But with earnings forecasts now significantly lower, a dividend cut or maybe even a suspension looks like a very real possibility. They might need to conserve cash.
Okay, valuation. After that fumble 2% drop, how does it look? Cheap? Fair? Compared to history and peers?
Dramatically cheaper, obviously. The crash caused a massive compression in the valuation multiples. At that 642.520 pence price, the stock was trading at a trailing price-to-earnings PE ratio of just 7.3 times based on last year's earnings. Looking forward, maybe 9 to 11 times expected earnings, though those earnings forecasts are now shaky.
And how does that compare?
It's a huge discount compared to its own recent history, where it often traded between, say, 14 and 20 times earnings. And it's also cheap relative to the broader specialty retail sector. There's clearly what you'd call a trust discount baked into the price now. The market is seriously questioning the quality and reliability of their numbers. Rebuilding that trust won't happen overnight.
So if we try to estimate its intrinsic value, maybe using a discounted cash flow model, a DCF, what does that suggest?
Right, a DCF model tries to estimate the present value of all future cash flows, based on a conservative set of assumptions now. The intrinsic value might be estimated somewhere between, say, 850 pence and 1100 pence per share.
So quite a bit higher than the current price of 642.50p.
Potentially, yes. It suggests there could be a significant margin of safety at the current price, that buffer between price and estimated value. But, and this is but you have to be really careful with the assumptions. We assumed near-term growth would basically stall 0-2% free cash flow growth, then pick up to maybe 6-8% medium-term and level off at 2% long-term. And crucially, we cranked up the discount rate, the WACC, to 11.33%. That's the old 8.83%, plus a hefty 2.5% risk premium to reflect all this heightened uncertainty and risk. Small changes in those assumptions can really swing the valuation.
Okay, that's the financial picture, heavily impacted by recent events. Let's move into the second part and look at the fallout, starting with Chapter 4, Market Sentiment, Gauging the Fallout.
Right. So before August 21st, the mood among analysts was generally positive. You saw moderate buy or buy ratings. The average price target was up around 1,300 pence. Obviously, that's completely out the window now. Those analysts are scrambling to revise their models. You're going to see a wave of downgrades and much lower price targets. This creates what we call a sustained period of negative news flow and an analyst overhang. Basically, bad news keeps dripping out, putting a ceiling on the share price for a while.
And the media reaction, you mentioned headlines weren't kind.
No, the impact was immediate and harsh. Headlines used words like plunged, crisis, accounting error. The narrative flipped instantly. It went from a strategic growth story to one of crisis and mismanagement. And those comparisons to the Tesco scandal are really damaging reputationally.
What about market indicators? Short interest people betting against the stock.
Yeah, short interest tells you how many shares are being borrowed and sold short, expecting the price to fall. Leading up to this, short interest was relatively low, maybe 1.3%, 1.4% of the shares available. Firms like Citadel, GLG Partners were involved, but now it's highly likely short interest will jump significantly. The accounting issue, the loss of confidence, it makes for a compelling story for short sellers.
And technically, looking at the charts, moving averages.
It was a complete technical breakdown. The price slicing through its 50-day moving average, around a 1,072p, and its 200-day moving average, around 11,120p, 11,160p, like that. That confirms a major new downtrend for technical traders. It probably forced selling from trend-following funds and will attract more short-term traders betting on further falls.
So the sentiment turned very negative very quickly. Let's look at who actually owns the company now. Chapter 5, Ownership Structure.
This is important. WH Smith is overwhelmingly owned by big institutions, pension funds, asset managers, that sort of thing. Professional money managers. Some sources say institutional ownership is as high as 91%. Others put it more like 60% to 75%. Either way, it's the big players who largely decide the stock's fate.
Who are the biggest holders?
It's quite concentrated. The top 5 control a big chunk. You've got Causeway Capital Management, BlackRock, Capital Group or Artemis, M&G, and Vanguard. What these firms decide to do now, hold, sell, or maybe even buy more at these lower prices, will be absolutely critical. If they lose faith and start selling, it could trigger more selling.
We'll need to watch the next round of filings.
Definitely. Those 13 filings in the U.S. and similar disclosures elsewhere will be closely watched.
What about the people running the company, insiders? How much of their own money is tied up in shares?
Very little, actually. It's a stark contrast to the high institutional ownership. Insider ownership is only about 1.2% of the total shares. For context, the CEO, Carl Cowling, held about 61,000 shares. The chair, Annette Court, had around 6,900 as of August 2023. Pretty small stakes relative to the company's size.
Any recent buying or selling by insiders?
It's been mixed and fairly modest. The chair bought some shares in April 2025. Another director bought in November 2024. But interestingly, the outgoing CFO, Robert Moorhead, actually sold some shares back in November 2024. This low level of insider ownership. While some investors see it as a potential misalignment of interests, especially when the share price drops 42%, you want to see management feeling the pain too.
So highly concentrated institutional ownership, low insider ownership. What does that concentration mean for volatility?
It means decisions by just a handful of large investors can have a really big impact on the share price, up or down. It can definitely lead to increased volatility, especially in times of uncertainty like this.
Okay, let's broaden the view again. Chapter 6, Risk Assessment. A widened threat landscape. How has this crisis changed their overall risk profile? Maybe using a SWOT framework.
Yeah, the SWOT analysis, strengths, weaknesses, opportunities, threats, looks quite different now. Strengths are still there. That pure play travel focus, the strong brand, the cash generative model, good landlord relationships. But weaknesses are now dominated by this critical failure of internal controls, the damage management credibility, the high debt, and that low insider ownership we just discussed. Opportunities. Well, the travel market is still growing. If they can fix the issues, maybe they can still gain share in North America, category expansion, and potentially the shares could re-rate higher if they restore trust. Big if. And threats have intensified. Huge reputational damage. Intense competition hasn't gone away. Macroeconomic headwinds are biting, and geopolitical risks, too.
Let's talk about those macroeconomic headwinds. Inflation is back up in the UK. Interest rates are uncertain. How does that hit WH Smith?
It hits them in a couple of ways. Mid-2025, UK inflation did tick up again. CPI hit 3.8% in July. That directly increases their operating costs, wages, energy, supplies. It also eats into shoppers' disposable income, so people might cut back on non-essentials even when traveling. And interest rates. The Bank of England cut rates to 4% in August 2025, but with inflation popping back up, further cuts look less certain. For a highly leveraged company like WH Smith, higher or even stable rates mean higher interest payments on their debt, more pressure on cash flow.
And geopolitical factors. They're global, big in the U.S. Any trade risks?
Yes, that's another layer. In 2025, the U.S. brought in a new trade policy, including a baseline 10% tariff on many goods coming from the U.K. That directly increases costs for their crucial North American division. Management has a tough choice: absorb the cost, hitting margins even more, or try to pass it on to customers, potentially hurting sales volume.
So you've got this external trade pressure hitting the same division where the internal accounting crisis happened.
Exactly. It's a nasty convergence of risks. The North American division, meant to drive growth, is now under pressure from both outside and inside. It just diverts management time and resources away from fixing the core business and towards firefighting on multiple fronts. Makes the turnaround harder.
All right, we've covered a lot of ground. Let's bring it all together. Chapter 7, Conclusion, Opportunity or Value Trap.
Yeah, this is where we try to make sense of it all. WH Smith is clearly at a major turning point. The investment case really boils down to a battle between what looks like a sound long-term strategy and this very severe, very immediate crisis of confidence.
So let's lay out the bull case. Why might an investor look at this 42% drop and think, this is a buying opportunity?
Okay, the bull argument goes like this. The market has massively overreacted. 42% is too much punishment. They'd point to the clear strategy, pure play travel retail, plugged into strong secular growth trends in global travel. That underlying trend hasn't changed. The valuation is now incredibly low, potentially well below intrinsic value, even using conservative estimates. There's a big margin of safety. The core business model works, it generates cash, it benefits from that captive audience. And if this accounting error was an isolated mistake, something that new management and better processes can fix, then the long-term earnings power of the business is still there. The market might be pricing in a disaster that won't actually happen.
Okay, that's the optimistic view. Now, the bear case. Why might this be a classic value trap? The stock looks cheap, but just keeps falling.
The bears would argue that this accounting scandal isn't just a one-off mistake. It's a symptom of deeper problems, a fundamental failure of governance and controls. It raises the cockroach theory. Where you see one cockroach, there are probably more hiding. Are there other accounting issues lurking? Management's credibility is shot. That trust discount we talked about could stick to the shares for years, preventing them from recovering properly. The fact the failure happened in the growth engine, North America, suggests the whole growth story might be flawed or at least significantly delayed. And finally, the company's financials are fragile, high debt, low liquidity. There's just no room for more mistakes. The balance sheet is under real strain.
So going back to our valuation work, the DCF suggested a range of 850p to 1100p versus the current price near 640p. How much weight should we put on that?
Our DCF model, adjusted for all that extra risk, does suggest potential upside. That 850p to 1100p range implies a significant margin of safety at the current price. But, and I have to stress this again, interpret that with extreme caution. That valuation is incredibly sensitive to assumptions about how well they navigate this crisis. Can they restore discipline? Can they regain trust? The wide range of the valuation reflects just how uncertain the answers to those questions are right now.
So bottom line, what does this mean for someone looking at WH Smith stock today?
I think an investment in WH Smith right now is basically a bet. It's a bet on the new CFO, Max Izzard, and the rest of the leadership team being able to pull off a fast, credible turnaround. The numbers might look tempting, shouting bargain, but those crucial qualitative factors, management integrity, competence, internal controls, things that are the bedrock of any good long-term investment, they're now seriously in doubt.
So the question you, as a potential investor, have to ask yourself is, are the underlying strengths of this travel retail business strong enough to outweigh these really serious governance concerns and the shattered trust? It's a tough call. And that wraps up our deep dive into WH Smith PLC, a complex situation indeed. We hope this exploration has given you a clearer picture and some food for thought.
Absolutely. And just a reminder, this analysis was generated by an AI system. It's for educational purposes only and definitely shouldn't be taken as financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.
That's right. And if you found this deep dive helpful and want more like it, please do like this video and subscribe to Stock Analytics AI on YouTube. Members get priority deep dives on tickers for just €4.99 a month. We're planning to cover all the S&P 500 stocks over the next few months, and members get exclusive priority access to those. Or, if there's a specific company you'd like us to dive into, just drop us a super thanks on YouTube, and we'll see what we can do. Thank you so much for joining us on the deep dive. We'll be back soon with more fascinating insights.